the reason that this matters is because this brings the traditional capital markets infrastructure on chain. So you can now start to use treasuries, use CLOs, use these financial products as collateral to borrow, to hedge, to leverage against, not just buying and holding them. So as we make steps as an industry, as we bring treasuries on chain, it's a move towards greater maturity of the space. But until we really have that infrastructure around it that is expected in off-chain environments, we're not going to see the same level of sophisticated and traditional investors that are participating in these types of assets on chain. So Aave has always been an early adopter and innovator as it relates to real-world assets.
Welcome to Tokenized. The show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Simon Taylor. I am your host for today, author at FinTech Brain Food and advisor at Sardine. And I'm joined, as always, by the fantastic, the incredible, the unbelievable, the effervescent Cuy Sheffield. How are you doing, sir?
I'm fantastic. We've got great guests. We got a lot to cover. Let's get into it.
All right, yeah. Let's start with our first guest today, Andrew Huang, founder of Conduit. Tell us about you, Andrew. Tell us about Conduit.
Yeah, well, thanks for having me, Simon and Cuy. I'm the founder of Conduit. We do chain infrastructure. And so we help teams like Athena, Securitize, and Polygon build their own custom chains. And, ultimately kind of the last mile and customization, performance, scalability, security solutions there. What we're really excited about over this next year is kind of the institutional and fintech adoption. So I think Circle and Stripe launching their own chains here is incredibly interesting for us. We spent a lot of time in kind of the core crypto native categories, and it's very exciting to start to see some of that institutional and kind of finance kind of from off chain start to come on chain.
Yeah, I would love to get your thoughts on that, actually, as we come to our first segment of the show. But we're also joined, really, really excited to be joined by Bhaji Illuminati, who's the CEO of Centrifuge. Thank you so much for joining us. Tell us a little bit about you and tell us about Centrifuge.
Hi, thank you so much for having me. I've been a major fan of this show from the very beginning and happy that me sliding into your DMs many, many months ago resulted in this conversation today. So Centrifuge, we've been around since 2017. We are one of the original founders of the idea of real-world assets. So we've been really focused on tokenizing assets, creating this bridge between off-chain institutional financial products and on-chain capital allocators and treasury management. We are at $1 billion in TVL, so of course small in the grand scheme of things, but top 3 as it relates to RWA platforms within the sector right now. Over the many years have survived multiple cycles, learned a lot, iterated a lot, focused on different types of asset classes, different types of go-to-market motions, and have really gotten to this point today where we do act as this liaison where we strive to be the best on-ramp for institutional asset managers to come on chain to tokenize, manage, and distribute those funds. So really excited to be here and jump into the conversation today.
And I should mention as well, we're excited to welcome you as a sponsor. Tokenized is also brought to you by our friends at Centrifuge. Through every crypto cycle, Centrifuge has been building, and today they are the market leader in tokenized real-world assets. Back in 2017, they were one of the first to mint a stablecoin backed by real-world assets with Maker. They're now launched an RWA lending capability with Aave, which is over $1 billion in total value locked. And Centrifuge works with major institutional partners to tokenize and distribute their funds. From treasuries to credit strategies, Centrifuge connects traditional finance to decentralized markets, creating new ways to access and put capital to work. Centrifuge is more than simply part of a tokenization wave. They've been kind of driving it in many, many ways. Whether you're an asset manager or a fintech exploring tokenization or a stablecoin allocator seeking high quality institutional yield, look no further than Centrifuge. Two quick bits before we get into the content. Reminder, we're doing our first ever Tokenized live in London on the 11th of September. Tickets are completely free. Thank you to our sponsors. To register, click on the link in the description, wherever you're watching or listening. And of course, I need to remind you that views and opinions of our contributors today are their own and might not reflect those of the companies they represent. Please don't take anything we say as tax, legal, or financial advice, or fashion advice, or sports advice. It's not advice. Do your own research, folks. All right, Cuy, you wanted to start with something today, I believe.
Yeah, before we get into the news, Simon, we got to start with your latest fintech brain food piece. Every bank should tokenize deposits. This is something we've been debating for a long time. I've gotten a bunch of people pinging me about this blog post. Give us a quick rundown on your thesis here, and then would love to hear Andrew, Bhaji, and others, your take on tokenized deposits.
Sure. The world seems to think it's stablecoins versus banking and TradFi, and I just don't think that's true. The world seems to think that stablecoins means we're entering a world of narrow banking and that this is de facto competitive with banking. And there will be some competition, don't get me wrong, but I can't imagine a world in which some of the world's largest balance sheets don't play a useful role. I really, really love what Centrifuge is doing, and I really love this alternative way of providing, stablecoins and deposits and different types of lending. The market needs credit, the market needs innovation, but the market needs people that have learned from centuries of market cycles like booms and busts and recessions to be able to absorb shocks. The market needs people that can serve Fortune 500 companies, and those Fortune 500 companies will probably want to get access to stable coins. They'll want to get access to DeFi markets, and they'll want to do that through their bank partners. So I think it's less of a stable coins on one end of the spectrum and tokenized deposits on the other, and these things are fighting each other. I actually think they will coexist in the same universe, insofar as really a token is a token, but what it's backed by may vary. A token can be backed by treasuries and a stablecoin issuer. A token could be backed by something else and may not be a permitted payment stablecoin in the United States under Genius. Or it could be backed under the Genius Act by deposits held at a bank, and those banks can lend against it. They can do whatever they want. And there was a lot of people speaking to me saying, Simon, how would you tokenize a deposit? And I was like, well, surely it's very simple, isn't it? And they were like, no, nobody's ever drawn the diagram for me. So one of the things I did was just build a really simple sequence diagram that says, okay, well, all you have to do is move the deposit into a minting account. So the deposit just stays inside the bank from a balance standpoint. And then you mint a token on chain that represents that deposit. And so long as that deposit can still be found later on, from a bank's perspective, you can do whatever you want with it. You can lend against it. You can do all of your treasury management. There's just this other version of it existing on chain that you now need to track and chase. And then once it's minted, you can then send it to a beneficiary wallet and out into a blockchain network. Now, which blockchain network? With which compliance requirements? That's the thing that everybody seems to get to second, and I think that's the debate. And that was a lot of the thrust of my argument is there's still a bunch of questions about privacy and KYC and all of the engineering trade-offs. So that was the centerpiece of it. But Andrew, you sort of mentioned you're interested in larger organizations coming on chain. What are your thoughts on tokenized deposits? Bad thing, good thing?
I mean, I think it's a good thing. I think it's somewhat similar to stablecoins. I think it's ultimately a different kind of asset, right? I think stablecoins, typically backed by short-term treasuries or overnight repo markets, you can have a lot more confidence in that. Bank deposits are generally pretty high quality asset. I think it's a bit harder to get on chain, kind of as you alluded to, in a way that preserves kind of privacy and a lot of the compliance and regulations that banks have to deal with. And so I think for us, ultimately, that's maybe what the interesting problem is if you can bring these on-chain deposits or kind of these deposits on-chain, give access to liquidity and DeFi native services, Certainly that's something like DeFi would be interested in, right? Is new liquidity streams kind of coming into the ecosystem. But is there a way to do that while satisfying kind of really kind of the permission and private nature that, these kind of exist in off-chain today? So ultimately, kind of for us, how we think about it is, one, it's a huge source of what we would call sustainable kind of supply and demand for blockchains. I think if you look at a lot of the organic activity today, it's a lot of speculative kind of finance, and it tends to move around into kind of various places. And a lot of these chains are kind of competing over kind of those same sources of speculation. But why things like the Stripe chain and like Circle chain, and maybe we'll talk about the Google L1 kind of down the line, is like these have the opportunity to bring kind of these more sustainable sources of demand on chain in a way that I think leads to durable revenues and all the things that I think us and Bhaji here at Centrifuge are kind of excited about.
Yeah, I think you raised a couple of great points, and to the point about what Google's announced, from the looks of it, they did a pilot, I believe, on their closed permissioned chain back in March with CLS Bank, who are one of the major FX banks in the world. And so that would resemble sort of the Google version of a Connexus or a Citi token services. I think these things are very, very interesting because certainly in the case of Connexus or Citi or HSBC, they're already moving trillions as tokens. And people wonder, like, why are banks moving millions as tokens? Couldn't they just update their mainframes? And actually, unless you've worked inside of banking, like, couldn't they just, it seems like a really easy thing to do. It's possibly the hardest thing they will ever do in existence. It might actually be a lot better to abstract their mainframes away into one consistent global ledger and use that as their source of truth over time. And what that does is, inside their closed loop, is it gives them 24/7 instant settlement across borders. What I'm suggesting is tokenized deposits help them gradually go open loop. And so I'm very excited by, ZK Sync's Previdium's idea and what that might look like on some of the new L1s. And how you could give banks sort of the ability to take their deposits on chain, but in a semi-closed loop, but in a way that could be atomically swapped for a stablecoin and or some other asset that then flows on chain just as everything else does, because they have a lot of Fortune 500s that want to give access to stablecoins. And this is a really neat firewalled way to almost think about how you might do that. Bhaji, I know you've been doing a lot bringing real world assets on chain for a while. What are your thoughts on the deposit side, if any?
Yeah, I think it's really an interesting conversation. And there's, of course, a lot of opportunity for banks. And it makes a lot of sense that banks are interested in this. To touch on Andrew's point a bit and where it gets most relevant to Centrifuge is, what can you then do with that token once it's on chain? So are there opportunities to make it more programmable and more deeply integrated within DeFi? Can you lend against it? And can you start to use it as this collateral asset? Which I think is very interesting in many ways. From the bank's perspective, it makes those deposits more sticky. From the user's perspective, it creates opportunities for broader utility and growth and leverage within the system. There are, some questions around, what does that do, like, for potential systemic risks if there's effectively the ability for the bank to still lend against the deposit, and then a second life created for that same dollar on chain. So it amplifies leverage across the system and could, potentially be a flag in terms of like how regulators are thinking about the potential utility. So one area to definitely continue to look at and double click on. I think ultimately, like, we are making very good progress, but there is still a big question around if the Fed and FDIC will agree to this. From their perspective, there's quite a lot of focus, of course, in the Genius Act, clarifying how banks can engage in crypto activities. What are some of the foundational and structural rules that need to be agreed upon? And this is another area that will require a lot of nuance, a lot of work to be done in terms of how it can be regulatory, how it can be sound and work really well within the existing structure and system.
Non-trivial.
Non-trivial.
Yeah.
I mean, just thinking about the rules right now around internationally agreed risk weighting for different types of assets, and like how much has been built and baked into this system that needs to be thought through and built in a way that protects, the most valuable asset we have as a country, which is our banking system.
The other type of RWA, the risk-weighted assets. Yes, the
God,
true bankers
I know.
know that one for sure.
Yeah,
I didn't use the acronym to spare the audience.
Yeah, I feel like we go back and forth on it. Sometimes we say RWA, sometimes we don't, and I fully understand the argument to not use that term. I think on this topic, there are a bunch of big open questions. I think my starting point is just where are we today, and what have we seen to date? And I think that has been large banks, like JPM, using tokenized deposit type of systems for 24/7 intra-bank transfers. And it seems like that is working. And, they've announced, significant volume that they've moved, through Connexus and the JPM, coin system. And then Citi Token Services, I don't know if they've announced, volume, but sounds like a similar use case of if you're a global bank and you have many different core ledgers and, people want to move from JPM New York to Singapore to London, like being able to have this abstraction of a new modern 24/7 ledger that happens to be a permission blockchain where you can move funds 24/7. So I fully expect that is a use case that has value and will continue to grow. I think the question in your piece, Simon, is do we end up going beyond that from both a regulatory perspective and a bank risk tolerance perspective? Are you going to be able to have deposit tokens that actually are able to go to consumers outside of the bank? And it's interesting to see this next step of, Connexus is kind of a closed permission system just operated by JPM. They now have JPMD issued on Base. And so now you're using a public blockchain where theoretically someone could use any third-party interface to be able to hold JPMD, but it's still, as I understand it, permission to only JPM customers. So JPMD can't just trade on an exchange. It can't circulate freely. It can't be held by someone who's not a customer. And so I think there's a question of, will tokenized deposits be able to function more like stablecoins where they can flow freely? Or if not, then if you always have this dependency around you have to onboard a customer into the bank, is it more about serving existing customers and just doing 24/7, faster, internally inside of a bank? Or are there systems where you might have on-chain finance protocols that are KYB'd or KYC'd, and banks actually acquire new customers, they get the right KYC information, and they serve their deposits into these different ecosystems? And it's just not clear what that's going to look like yet. But I think right now it has not left the walls of a bank, and it's not obvious whether or not it's ever going to leave the walls of a bank, where stablecoins are very clearly this open loop ecosystem that is moving between many different entities, not just inside the stablecoin issuers.
Yeah, I think they're two ends of a spectrum today. And what I can see is you don't bring 2 trillion on chain without thinking it through first. Like, you're going to definitely really be thoughtful about every potential risk. But I was thinking more about their corporate customers, not their consumers. A large global corporate has supply chains in 190 countries. For that large global corporate that is already fully KYB'd, that you have a very secure relationship with, that customer is somebody that is very interested in stablecoins and asking you about it. And so that customer, how would you give them an easier on-ramp into the stablecoin ecosystem whilst retaining as much of that relationship as possible as a financial institution? The way you might do that is in some sort of VPN-like version of taking your deposits on-chain. Your deposits exist on-chain, but only for your KYB to KYC customers. But because they're now on chain, you can atomically swap those for stablecoins as a KYB customer with somebody else. That corporate can cash manage however they see fit with multiple institutions. You as a financial institution have made their lives easier. That was my primary sort of baby step that I was suggesting, really as an evolution of where they are today, because I expect them to be incredibly cautious, incredibly baby steps, especially the GSIBs, focusing really on their institutional clients. I do think for some of the smaller banks, for the embedded finance players, for the fintech customer ecosystem, like our Robinhood, Revolut, Nubank, I think you'll see a lot more innovation there on how do deposits change for stablecoins. And I think that like consumer acquisition funnel becomes a very interesting question for those non-banks and a very interesting question for remittance companies. Like I really think, Cuy, with that segment, you've definitely got something. And in that world, remember, all of the non-banks are customers of the big banks. So maybe those non-banks who've gone more into the on-chain world would like a tokenized deposit to swap against when they're balancing things. So I think there are ways to serve this ecosystem that are not. We tend to default to thinking consumer, but actually there's a much broader opportunity for financial institutions that's much lower risk. So baby steps.
Yeah, Andrew, would love your take on, like, do you think banks are going to, if they do a tokenized deposit, be willing to do it on an existing chain, or are they going to look to say, let's create our own chain? And then if they're going to create their own chain, is it an L2? Is it an L1? Like, what have you seen in Conduit as you've evolved from, serving crypto natives to institutions? Do you think part of the requirement of creating the tokenized deposit is going to be their own chain along with it?
Yeah, I think, in our explorations there, I think every institution is a little bit different, and it's like still very early. I think that being said, in terms of what we're seeing as hard requirements, I do think that I think a major question that comes up is this mostly an internal kind of facing ledger, or is this something that connects with other banks and institutions? And if it does, is that some sort of consortium chain? And if it is a consortium chain, how does our privacy and kind of permissioning kind of plug into that? And so it's a pretty complicated problem. I would say that maybe there's like multiple layers to the solution. And as an example, if you look at a Stripe L1, which is not a roll-up today, I think there's an aspect to that which many different players can be a part of that chain, and it's not owned by any single entity. From an uptime perspective, having multiple operators is kind of helpful. And then for things like privacy and permissioning, which are very hard to do at an L1 level, because of the nature of them is that many people are have the ability to validate and kind of be a part of that network. That's really where we think rollups are going to play the biggest role, is in on a per kind of issuer or like bank or kind of institution basis, be really the hub and kind of core ledger for kind of serving those kind of use cases. And the ultimate connectivity layer is probably going to be these more neutral L1s, whether that is something like Stripe L1, Circle's Arc, or even something like Ethereum.
I think that's such a good point. Like the L2 is the mirror to your internal core ledger. And we don't know what the L1 is going to be, but that L1 being somewhat neutral and credibly neutral is a really important point, because if it is credibly neutral, then you avoid platform lock-in. And I think a lot of financial institutions in particular have avoided going fully cloud native because of some of the drawbacks of platform lock-in. Even if you're multi-cloud, even if you're something else, there are good reasons why platform lock-in is a concern. And there are lots of sort of uptime reasons, sure. There are lots of security reasons. There are lots of other good reasons why platform lock-in is to be avoided. So the more credible neutrality you can build whilst also imbuing it with distribution, I think it's an interesting trade-off that we're going to see these networks start to emerge, because the Connexuses and City token services have a lot of distribution, but they're locked into their own ecosystem. There's only so much fun you can have on your own blockchain. At the opposite end of the spectrum, one might argue that Bitcoin's a bit too slow for regular payments use cases, and its sort of layers above it, Lightning, are not the VPN model of L2 that you've just described, where, the L1 is for everybody, this sort of settlement infrastructure for the internet, and then above that you get this VPN, which mirrors almost your internal system. Great point. We can talk about this all day. So thank you for indulging this, and Cuy, thanks for bringing it up. I do want to bring us to this other story from Aave. So they've launched their RWA market Horizon, and that enables tokenized real-world assets to serve directly as collateral within DeFi, meaning institutions can unlock stablecoin liquidity against tokenized assets without needing to sell or redeem them. So this is like secured lending, really. And for lenders, Horizon provides access to those new yield opportunities. So they've got a bunch of options from Superstate and Centrifuge and Circle and many, many others. So, Bhaji, do you want to explain this one to us? Because I figure you're pretty close to it and might know what's happening here.
Very close to it, yeah, and really glad the timing worked out where it was announced yesterday, so we can talk about it today. So this is really cool from Aave. We view it as it's more than just another RWA market, where there is some RWA lending and utility use cases that are being developed on Morpho and across a couple different vehicles on chain. The reason that this matters is because this brings the traditional capital markets infrastructure on chain. So you can now start to use treasuries, use CLOs, use these financial products as collateral to borrow, to hedge, to leverage against, not just buying and holding them. So as we make steps as an industry, as we bring treasuries on chain, it's a move towards greater maturity of the space. But until we really have that infrastructure around it that is expected in off-chain environments, we're not going to see the same level of sophisticated and traditional investors that are participating in these types of assets on chain. So Aave has always been an early adopter and innovator as it relates to real-world assets. We actually built a real-world asset market with them back in 2021. It was called RWA Market. Very early, first of its kind. In retrospect, too early. At that point in 2021, there weren't the right assets on chain. So there was a duration and yield mismatch where very long duration, a couple years, very low liquidity and pretty low yield. So we weren't able to really see that type of interest and activity that we believe we're ready for now. We got to about 18 million, but as we look at Horizon, they're, when I checked a couple hours ago, at 48 million in just 24 hours. So Aave putting their brand behind it, putting their trust behind it is exactly what we need to see for these types of primitives to gain adoption. I think Stani posted a tweet a couple weeks ago saying that Aave is now like the 37th largest bank, except it isn't a bank, but a network for any financial institution to plug into to unlock non-Fed correlated yield. So pretty bold, but also very indicative of the fact that Aave has established themselves as this very trusted brand that's very secure, that creates deep liquidity. And because of that positioning and influence and role that they play in the market, enabling these types of opportunities around RWAs is exactly what's needed to see that next phase of utility and growth for RWAs. So for Centrifuge, we have our T-bill fund, which is JTRSY, and we have our AAA rated CLO fund, which is JAAA available. Superstate has their T-bill fund, and then they have their carry trade fund, which is available. So some really great RWAs from launch paired with a number of great stablecoins. So we're at a position now where we expect this market to perform really well. We have the right RWAs in place, a diversified mix of different options across the yield and risk and liquidity curve. We have the right stablecoins in place with a very similar structure. And then Aave's facilitating this exchange and opportunity between the two parties.
Yeah, this seems like a really big deal and part of a theme that we've been talking about on the show for a while. It's pretty clear that DeFi has been able to get product market fit within crypto natives, where you can go to Aave, and Aave's been tremendously successful, enabling anyone to lock up ETH or other types of crypto assets as collateral and be able to borrow stablecoins against them. And there have been billions of dollars of loans that have been dispersed in stablecoins. But the question has been, okay, is it only going to be crypto assets as collateral? And then, because they're crypto assets, then they're volatile. And so then what's the loan to value ratio around, how you're borrowing against your ETH? Can you take all of that technology and infrastructure and make it useful for asset-backed lending with traditional assets? And it feels like that's been like the idea for a long time, but we haven't really seen it, implemented, at scale yet. And so I'm really interested in, Andrew, I don't know if you have a perspective on going from pure DeFi, permissionless, anyone can deposit, anyone can withdraw, to now if you're bringing in these real world assets, these tokenized treasuries, you have to start to design for, okay, well, there's a allow list on some of these products around who can actually hold or redeem them. And so it can't just be 100% permissionless across the board. How are you seeing this balance of using this open source infrastructure to create lending markets while still accounting for compliance and the requirements that the institutions who are working with Centrifuge have around where their assets are held or how they're being used?
Yeah, definitely. I think maybe the best example is something like what Athena and Securitize are building in Converge chain, which is, in their mind is kind of the convergence of like institutional capital with like more DeFi native and stuff. And so for those that don't know, like Athena is probably I think the number 3 stablecoin kind of at this point. And they basically execute like a basis trade. And use that yield to kind of fund yield for holders. Part of their chain design is, and kind of one of the problems generally amongst crypto native protocols is that there's only a certain amount of crypto native liquidity out there. And once you get to 5, kind of 10 billion or so, you might in some ways kind of be tapped out. And the question is, where is this additional capital going to come from? And if you look at the snapshot of like crypto native capital versus capital in like the rest of the market, it's pretty clear that, there's still a ways to go in terms of bringing on, whether it's RWAs or institutional capital or kind of all this stuff into kind of more interesting DeFi native kind of schemes. I think what it will probably require, so DeFi native stuff tends to be, as you mentioned, like Wild West. Anybody can kind of do anything. And because of that, there's a lot of risk. I think what we're seeing is for more of these like regulated RWAs, you typically need some kind of KYB middleman that is running a specific set of strategies that are kind of like, given the blessing of kind of these institutions. So Athena, obviously using USDTB, which is like BlackRock's kind of treasury bill fund, and kind of the securitized Athena relationship, being able to know kind of who they're interacting with, knowing who they're dealing with, but then being able to use a lot of the Athena strategies to generate yield, I think is a very interesting kind of format for how these kind of two will end up converging.
I think it's fascinating to see this kind of move of liquidity into the markets through real world assets, and the sort of tension on both sides where the on-chain markets need it, but they have to get KYB to get there. And the institutions want to come in, but they need KYB to get there. And it's really creating this interesting pinch point on how do you balance this tension of universal infrastructure that anybody can access, but building these pockets of KYB and KYI. So we'll come to a story a little bit like this just after the ad. So I do need to pause here to thank our sponsors, and we'll be right back. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's tokenized asset platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Bridge, a Stripe company. Just as the internet made information global, stablecoins are making money global. Bridge, a Stripe company, is the infrastructure powering that shift. It's built for speed, scale, and simplicity. Bridge helps businesses send, store, and accept stablecoin payments instantly. You can serve global customers without navigating the complexities of setting up those crypto rails. It's how companies like X, Shopify, and AirTM unlock new markets, reduce their FX costs, and move money at internet speed. Explore the future of global financial infrastructure at bridge.xyz. All right, thank you to our sponsors. The next story was actually about Circle, Paxos, and a couple of others testing a new way to verify crypto payments. So Blueprint, which is founded by friend of the show, Chris Brummer, estimates that today, phony and counterfeit stablecoins are costing crypto users at least 1.6 billion in losses on an annualized basis. And they have a new solution called Know Your Issuer that aims to reduce that amount dramatically by linking a stablecoin issuer's credentials to the asset on chain. So creating a strong guarantee between the KYB essentially they've done on Circle or Paxos and the actual stablecoin itself. And so Chris says in a quote, if you can provide provenance up front, you can reduce the complexity of KYB for everybody in capital markets and institutions. They're no longer worried about, is this a counterfeit coin? But I could imagine several other use cases for this if KYB or Know Your Issuer can actually travel with the token itself, and you can have strong cryptographic guarantees of this. So Andrew, this was largely to your point. I don't know if you saw this story or if you had a chance to look at it just yet, but thought this was an interesting segue from what you were just talking about before the ad.
Definitely. I haven't had a chance to take a look at this. I do think as more institutional and like kind of regulated finance comes on chain, auditability and kind of verifiability, becomes even more important. There are a lot of security solutions out there that have built businesses purely on filtering out kind of fake tokens. That kind of goes to show you how large of a problem it is. And I think even if you look at Sony has a layer 2 called Sonium, which is like kind of like a permissioned chain, and they're very sensitive to who is owning what, and they're issuing some IP on their chain. Very, very big issue for them was the creation of essentially like fake IP or meme coins, which they viewed as a big kind of like brand and reputational risk. So certainly being able to filter out those assets, having a way to determine who is issuing what seems to be key, particularly as we bring more of these real kind of assets kind of on chain.
I think there's a lot of very interesting ways to slice KYC and this in KYB. And a lot of it comes down to the point around we need to create the trust for institutions to come on chain. We need to work with regulators to ensure there's continued embrace of this industry overall. So now there's a lot of different inroads for how to think about ensuring that compliance. This is the embedded KYC on stablecoins that follows the token, I think is very interesting. To touch back on the point around how Horizon for Aave is structuring it, their approach is that the KYC is on the issuer level, and then it's fully permissioned on the stablecoin level. So in that way, you still can't get access to the RWA unless you do full KYC, KYB. For RWAs, there's full fund onboarding, KYC, KYB, where there's no secondary, or there's a type of security where you can do it on subscription redemption, and then there's secondary trading. So a lot of different ways to come about this challenge that we all know that we need to solve to really, truly grow the pie.
Yeah, it's amazing to see just the product and technology innovation, addressing real concerns that regulators have, and not necessarily waiting for things to happen that then require regulators to respond and create new rules. I think Chris has been an amazing innovator, saying how do we just create very practical solutions to these problems. And I think counterfeit and scam tokens, you're only going to see more of over time. There's nothing stopping anyone from being able to deploy a smart contract and make the ticker something that is either identical or looks like a real stablecoin or a real brand. And then if you have consumers that are coming across that token, whether it's in a social feed, in a self-custodial wallet, how do they know when they see there are 20 different tokens that all have the same ticker, which one is actually the entity that has the license to the brand that is who they say they are. So I think that this is going to become more of an issue, and we need new solutions like this. And it's been really interesting to see crypto and regulatory kind of tech companies creating know your transaction solutions on the on-chain analytics side, trying to address some of the AML challenges. And now you have know your issuer. So there are all these different approaches towards how do you use cryptography, how do you use some of these new solutions to solve problems. I also want to go back, Bhaji, on Horizon. Like, how do you think about who the end customer is? And like one of the topics that we've talked about on the show is it seems like most of the customers of tokenized treasuries are crypto native institutions. That there aren't like traditional institutions buying tokenized treasuries because they could buy regular treasuries. And so it's foundations, it's crypto native funds. Do you see that today with Horizon, or is there a world where you would see traditional institutions coming on chain, buying a tokenized treasury, and then using that as collateral to borrow a stablecoin? Like, what does it take of like where we are today with the existing customer base to who do you think the customers will be in the coming years?
Yeah. Right now, where we are today is still mostly all going after the pool of on-chain capital. But a big reason that's the case is because there hasn't been the same infrastructure around these financial products on-chain as there is off-chain. So I do think this is an important step to getting us there when we start to allow the same types of utility mechanisms on-chain as off-chain, and doing it with Aave and under the brand of Aave that has done such a great job to establish themselves as trusted within the ecosystem on-chain and off-chain is an important step. So I think there needs to be broader drivers across DeFi more generally. So from an institutional perspective, now we say, okay, you can buy the tokenized version of the treasury on chain, you can borrow against it. And then once you borrow against it, now you are open to this big, wide, beautiful world of DeFi, and you can do all this cool shit. So there's like an incremental step where they get the baseline expectation of what they need to achieve from the current process off chain. And then they get this added an incremental value that they can't get off chain. And then the pair of those creates an opportunity for them to say, we're willing to take this added level of risk and added complexity because we have so much upside in these certain areas.
Yeah, I think so long as we can continue to deliver on that promise and the upside, the business case will make itself for institutions. And that's the critical thing here is it has to make business sense. You're either taking out existing business workflow complexity and or you're creating new revenue. And that second one, DeFi has been extremely good at consistently. And I think you have to learn a new way of operating. And that's why I think innovations like KYI are absolutely needed, because we've, as you said, we've seen this approach where you can exist inside the KYB pool on chain that's just for people that are allowed to buy those assets. But the promise of DeFi was always its decentralization and its ability to therefore be more interoperable with the wider world of assets, and sort of thinking about your firewalls or your demilitarized zones or your VPN approaches to, like, how do you start somewhere, but then also how do you have some level of assurance that can live out as the token flows between different networks over time. I think there's so much experimentation that it's really exciting. I do want to link us to the last story as well. Couple of funding rounds got announced just as we were going to record today. So first up, Rain raised a $58 million Series B led by Sapphire with Dragonfly, Galaxy, and several others. So Rain, of course, do stablecoin-linked cards, and they're, I think, a Visa principal member, and that allows them to do some very clever stuff around how if you're issuing a credit card, you can actually have that paid off as soon as a consumer pays it. The settlement is more or less instant. So some very cool stuff those guys are doing as Visa principal members. So shout out to those guys. Cuy, I wanted to get your thoughts on this first, because I know stablecoin linked cards are a thing we've come to several times on this show. Any thoughts on recent developments that you've seen in that space that you think our audience should know about?
Yeah, I think it's a major category. And so huge congrats to the Rain team, and they've been at this for several years now. And so as we talked about before, it's just we think that the best way to spend a stablecoin is to do it connected to a Visa card, because it works everywhere on day one. But the challenge is you need a lot of infrastructure that's specialized to be able to create those cards and enable them to operate. And so we're trying to update how Visa operates, being able to use stablecoins to settle those transactions. But we need this new class of program managers, principal members, issuer processors. You kind of need the whole ecosystem to become compatible with this new type of asset that is going to be tied to the card. And so it's been really exciting to see the growth of companies like Rain as they've kind of built out purpose-built solutions for stablecoin-like cards. And we don't really see a ton of demand in the US. Like, you have plenty of great options to hold and spend dollars. We see the demand in Latin America. We see it in Africa. We see it in Asia Pacific. And so we plan to continue to just do everything we can to grow stablecoin like cards as the way to pay with a stablecoin.
No, it's a really interesting category. I know dollar cards have been around for a while, but this is really, really exploding. I'm going to link to the other story and then come to the rest of our guests. Of course, M0, friends of the show, raised a $40 million round led by the crypto venture capital firm Polychain, as well as Ribbit and Pantera and Bain Crypto. M0 as well, Bhaji, I guess you're reasonably familiar with these guys. Stablecoin issuer that buys RWAs, Genius compliant, but they're sort of a stablecoin issuer, but also helps people quickly create their own stablecoins, more of a white label ecosystem within there. So interesting one. Your thoughts on sort of the growth of these different types of stablecoin issuers? Do they solve a different problem for different people? And your thoughts more broadly?
Very, very excellent. Congrats to Luca and team. We love M0. This infrastructure layer for stablecoins is a critical enabler for what you all are so famous of saying of every bank, every fintech, everyone needs their own stablecoin. So a lot of these folks who are now looking at how can we get to market quickly with a stablecoin have a trade-off of, do we build the tech in-house or do we use someone who already has the systems and the network and the infrastructure in place that can help us scale and grow that? So we see M0 playing a very strong role here. We see Agora playing a very strong role here. It's a very great segment of the market that enables this rapid adoption and utilization of stablecoins so that people can come to market faster. It's also a pretty close tie to like the tokenized RWA space as well, because folks like M0 work with folks like Centrifuge to manage the reserves, to manage the collateral that's backing and enabling those yields.
It's an ecosystem. Andrew, your thoughts on either of these stories?
Yeah, we're big fans of M0 and Agora. I think everybody's looking to stablecoins, especially in a high yield environment, as a revenue source. And if you have the distribution, it just makes a lot of sense. I think the key question for a lot of these, and we see this a lot on kind of the chain infrastructure side, is these chains kind of want their own stablecoin for revenue reasons, but in terms of like interoperability and like bridging, how do you convert these stablecoins, right? If you're going to have 1,000 stablecoins, that kind of like pairwise trading might be a tough kind of infra thing. And I think that's where these issuers like an Agora, like an M0 really come into play, where it's kind of the same infrastructure under the hood, even if these are white labeled as like different stablecoins. So it really, I think they'll end up building network effects over time and become like pretty powerful. And so, both are companies that, we'd like to work with. And, we currently have a pilot with Agora on kind of the stablecoin side.
That's really cool. I think it's an interesting question is like, where does interoperability live? So, Circle have done God's work integrating USDC with countless chains. So, you can kind of bridge between chains via Circle extremely easily. Or maybe you want stablecoins themselves to be interoperable. And should that stablecoin interoperability exist at the stablecoin issuer level? Should it exist at the network level? Should it exist as an opportunity for on-chain market makers or clearing above that level, like a Ubix, for instance? And we don't know. I suspect some level of all of that will be the answer, because the world is annoyingly complex, and there's never one simple answer to these things. But it's the excitement of being in this space. Is the business opportunity is real, and I think we're sort of in land grab mode for a lot of folks. That will create some level of fragmentation, but then also the market opportunity will tend to do its power law thing. Cuy, any closing thoughts on these stories?
Yeah, I think it's be fascinating to see how the white label stablecoin ecosystem plays out. You've got approaches. Paxos has been doing this, for a while, serving as the licensed issuer, doing these co-branded stablecoins. M0 is more of this network and ecosystem where you have many licensed issuers who are sharing, a common, scheme and smart contracts. And so I think we'll see, experimentation at many different, parts of the spectrum. And it's going to be fascinating. We nobody knows who's going to win, but I think we're going to have better products at the end of this. With all the competition coming into the space.
Yeah, game on.
One thing that's really cool, if I can just add, so we all talk a lot about, of course, growing the pie. When we talk about like all banks having their own L2s or all fintechs having stablecoins, this is an opportunity to grow the pie through their network. And then if we can enable, once they're on chain, atomic swapping and interoperability between chains, and this being a entry point for broader utility and programmability across chains, that can become a great funnel where the pie is grown through these thousands of L2s that then are connected into one centralized system where there's so much more opportunity on chain.
Yeah, it is grow the pie time. It certainly seems from everything I hear that we're starting to cross the chasm a little bit, the classic book of crossing the chasm. So the innovators stayed in DeFi. They never went away. That 2% who's there through bear markets and bull markets. And Bhaji, Andrew, it sounds like you've survived a few of those. Then there's the early adopters, maybe myself and Cuy. We're there, we'll have a play, but we don't live in this world. There's some TradFi stuff we've got to do occasionally and kind of get involved in that. And I think we'll always be around as well. But then there's the chasm, that gap between kind of this becoming an everyday thing. And my thinking is if we can just keep this momentum a little bit longer, we are perilously close to overcoming that. And I see a couple of weak signals, not just that fintechs are launching stablecoins, but it's a major feature in the Nubank app. It's a major feature of Robinhood, that they're using it for settlement, that they're using it for infrastructure, that they're using it for cross-border, that there is an entirely new growth opportunity of serving the global south consumer base through stablecoins as a rail to access them initially through payments and dollars, but then through other financial products. And then also at the other end of the spectrum, that the institutions, and certainly some on the buy side and the shadow banks, are really aggressively leaning into this as a new wrapper, a new way to think about market structure. And the larger traditional sell side institutions are now starting to think, okay, we have to build our own answers here. So it's going to be fascinating to watch. Even BBVA and Santander now let their customers buy, sell, hold crypto. PNC does. let's see if that's still true in a year's time. We'll have you guys back and see if we have crossed that chasm. And speaking of having you guys back, before that happens, Bhaji, where can people find out more about you and Centrifuge?
I am on socials at It's Bhaji, and Centrifuge is everywhere as well, just Centrifuge and then centrifuge.io.
Perfect. Andrew?
Yeah, I'm on socials. Andrew Huang on Twitter is probably the main one. And then we're conduit.xyz.
Fantastic. Cuy?
On X at Cuy Sheffield and visa.com/crypto.
You'll find me at SY Taylor on your favorite social platform, I guess, and you'll find me at fintechbrainfood.com, usually ranting about something to do with tokenized deposits and or AI and finance and payments and all of that kind of stuff. And if you haven't already, please go ahead and subscribe. Hit the subscribe button and tell everybody you know. Spam them till you can't spam them anymore about this show and make them listen. Hold it to their ear and make them listen. And if you really want to help us, do leave us a review. It helps others find the show. That's all for now. Catch you soon.